Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, March 5th, 2024. As always, we'll start with the executive summary from today's lead-off morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro event is China sends dour micro but positive macro signals, plus incremental evidence of our green shoots globally theme. So the nuance there is China set its annual GDP target at around 5%, an aggressive goal considering China's structural liquidity trap and oversupply in the property sector, which accounts for 25 to 30% of Chinese GDP. Premier Li Kang confirmed as much, quote, it is not easy for us to realize these targets. We need policy support and joint efforts from all fronts. Elsewhere, the first batch of final February composite PMI releases was generally supportive of our green shoots globally theme. In terms of market implications, Premier Lee's commentary and China's aggressive growth, employment, and inflation targets of around 5%, over 12 million, and 3% respectively, all but confirms China's liquidity impulse remain positive over the medium term. That those aggressive targets are coming with less fiscal support implies that PBOC will continue to be very active in easing financial conditions in the Chinese financial sector. We were prescient in mid-December to call for Beijing to front-load policy support early in 2024, and for that front-loaded policy support to accelerate the uptrend in global liquidity. The uptrend in global liquidity has been a boon for popular risk assets such as NVIDIA and Bitcoin. Cheers to you if you repositioned your portfolio when we identified the critical inflections in the U.S. and global liquidity cycles in November. Lastly, our green shoots globally theme is a positive contributor to our still positive medium-term outlook for global liquidity. Transitioning to our 42 macro dashboard here, getting a near oversold signal here in the dollar index. That's a negative for risk over on a short-term time horizon. In terms of we had a couple of oversold signals in the in Treasury yield space as well. So the 10-year nominal 10-year yield is oversold. That's it means bonds are overbought. And then you got a oversold signal in the 10-year tips yield, which means tips are overbought in price terms. So a quick question here. So as always, we'll wrap up from our question from our 42 macro community. Question reads, how should I interpret the potential energy stored in the coiled spring of the TGA and RRP? Given balances have drained significantly, is it fair to assume their potential to provide liquidity to support in the future is waning, or balance is still high enough to be considered supportive for the foreseeable future? And how many months of support do you think we have at the current drain rate? So we've been very clear about this in our research, mostly in our macro scouting report, which we do a deep dive on U.S. and global liquidity dynamics every month in our macro scouting report. And we've been very clear that we don't expect the good times in the liquidity space to end until around mid-year. Now, around mid-year could be, late April, May, June, could be July, August, or September. I'm not entirely sure of exactly when it's going to run out because these things are they're inherently unforecastable, just given that they're largely determined by the whims of our Treasury Secretary and fear and greed in the financial sector in terms of those balances. So it's not like we can forecast them. There's no real principal components you can do, PCA analysis you can do to figure out what actually drives them. But what we do know is that we can extend the current trends, and if you extend the current trend in the TGA balance, you're talking about another 2 months at least before the thing hits zero, at least 2 months, perhaps 3 months, and then the RRP, the reverse repo facility balance, has about 2 to 3 months left at the current trend. Now, the current trend can slow down, the current trend can speed up. We have no ability to forecast that. In terms of, so all we can do is monitor and make prognostications, which is what everyone else is probably doing. In terms of the Treasury General account balance, I want to say we were somewhere around $775-ish billion last I checked, which was only about $25 billion above the end of Q2 target. So that coiled spring is dissipated a decent amount in terms of the potential energy release there, potential liquidity release there. But again, don't forget that $750 billion target for the cash balance at the end of Q2 is just a target. I mean, it moves around. They move it around. They can take it to 500 billion right before the election. They could take the TGA balance to zero right before the election. We have no idea. We have to monitor these things in real time so that we can spot critical inflections in real time, like we did back in November. Exactly. So we'll wrap it up there. I think I've rambled more than enough for today. Everyone have a wonderful day out there. We'll catch you back here tomorrow. Cheers. Oh, and by the way, I'm going to be on the Schwab Network today sometime in 2 to 3 p.m. hour. I want to say close to the top of the hour. So catch up. I'll be joining our friend Nicole Pelletides on that platform. So definitely come check us out if you like to hear what we have to say here at 42 Macro. So everyone have a wonderful day. Cheers.